This morning. Welcome everybody, and we'll just go right on into the agenda.
I'll make a motion for Susan to chair.
Okay. All right, there's a motion on the floor, and there's a second. Any discussion on the motion? There being none, all in favor, please say aye. Any opposed? Thank you. All right, the first agenda item is the minutes of the meeting from April 25th, 2017. Is there any discussion on the minutes? There being none, is there a motion to approve the minutes from April 25th?
So moved.
Second.
All right, there's a motion by Mr. Romero, second by, and this is,
Bledsoe.
oh, did you?
I did,
Okay,
but you
all
can
right,
get
okay. Second by Ms. Bledsoe, and all in favor, say aye.
Aye.
Any opposed? Obviously, I've not had enough coffee this morning and enough conversation already to get myself going this morning. Slow go. All right, the next item is the fourth quarter expenses. For your information, is there any questions or discussion on this information? We're always such a quiet group of people. Okay, that's for information. The ratification of the transfer of the estimated payroll for $324,000 for the quarter. Is there a motion to approve the ratification?
So moved.
Second.
All right, motion by Mr. Romero, seconded by Councilmember Bledsoe. Is there any discussion on the motion? There being none, all in favor, please say aye.
Aye.
Any opposed? Thank you. The next item is the approval of the well, it's just for information only, for the unfortunate passing of Miss Moberly. There isn't any benefits or anything that are due. It's just showing that we have another member that has passed. This was a widow. And then next on the list, we're pleased to have our review. So I'll turn it over. Thank you so much.
I believe everyone has a copy of the presentation in front of them. On page 1 is a quick snapshot of both of the portfolios, the return-seeking portfolio and the liability-defeasing portfolio. And it was a very outstanding quarter. The return-seeking portfolio generated a total return of 3.14%, which means that there was about $503,000 of incremental value to the market value of the portfolio. The performance of the managed account outperformed the respective benchmark by 20 basis points, which is very solid performance because that represents just one quarter of returns. The liability defeasing portfolio also increased in market value. This portfolio is designed in order to target all the projected liabilities from the account and cover them all. So we're not as concerned about changes in market value, but interest rates declined during the quarter. So the market value has increased of that particular portfolio by about $204,000. During the quarter, $525,000 was dispersed from the account in order to pay for benefits. So we've provided periodic liquidity in order to meet those funding requirements. There are a few small changes in the overall structure of the portfolio, mainly in the area of the Vanguard Small Cap Index Fund and the T. Rowe Price Dividend Growth Fund. We were just shifting funds more towards international stocks. Because we felt that the U.S. stock market has done extremely well over the last several years, and with some of the uncertainties in Europe in terms of the French elections, Brexit, have basically coming to more sound footing, we feel more comfortable and more constructive about the international markets. So turning forward behind tab 1, as we have done in the past, a quick market update. The U.S. labor market continues to strengthen. In fact, over the last 3 months, we added 581,000 jobs in the United States. The unemployment rate improved and is now at 4.4%. So if you think back to your economist books, 4% unemployment represents full employment, that everyone that wants a job can get a job. And in the United States, we allow people to transition from one area of the country to the other. So 3-4% employment just represents basically people migrating from place to place. Average hourly earnings, which is a very important gauge of inflation, is growing at a rate of 2.5%. This is basically what's representing your year-over-year increase in paychecks. What employers have to basically pay their existing employees in order to retain them. Otherwise, other competitors are going to attract them and steal them away by offering higher wages. So we're seeing wages increase in the neighborhood of 2 to 3%. That's not too alarming from the Federal Reserve's perspective in terms of they want to have inflation in that 2 to 2.5% range. But as we see basically a lack of employees, and especially a lack of talented employees and skilled employees, we might start seeing inflation pick up in this area. Overall, there was a pretty quick reaction after the presidential election. Specifically, the markets were somewhat surprised that both houses of Congress, as well as the White House, was won by the Republican Party. And this sort of gave the markets a sentiment that everything that they could imagine would easily pass through Congress and then signed by White House. As we have clearly seen, even some of the top priorities of the Republican Party have not even passed through both sides of Congress. So there was an initial strengthening of the U.S. dollar in terms of when you're looking at foreign currencies, but that has weakened and tapered off. The yield on the 10-year Treasury note spiked higher, but that has also declined, and that's why the return-seeking portfolio, the liability-defeasing portfolio has saw a significant increase in market value during the quarter. And inflation expectations for inflation have also dampened in terms of there was talk that there would be a $1 trillion infrastructure bill that would be introduced. There hasn't been much talk at all recently about that piece of legislation. So it's been essentially a tale of two markets. The S&P 500, which is basically the stock market, a broad-based collection of industries, has seen tremendous increases in terms of this particular chart, and as of June 30th because of the reporting date, and was just a shy under 2450. We actually saw the S&P 500 increase even further. While if you think that the economy is running on all cylinders, that you would think that the Federal Reserve is going to be more aggressive in raising rates, but we haven't seen that translated into higher yields on fixed income investors. So people living on CD income, we're not seeing much of an increase there. In terms of total returns, the stock market has been an excellent investment. Three broad-based indices, the S&P 500, just for the 6 months ending June 30th, was up 9.3%. The Dow Jones Industrial Average, which is a collection of 30 stocks, was also up by 9.3%. And the NASDAQ has increased 14.8% year to date. All extremely strong performance levels. On page 7, short-term yields have increased. The Federal Reserve, headed by Janet Yellen, has raised rates every single quarter for the last 3 quarters. They started raising rates in December of 2015, skipped a whole year, next raised rates in December 2016, then March of 2017, and then June 2017. So we're seeing rates increase modestly. For example, the 2-year Treasury note increased from 58 basis points to 138. So we're going to see a little bit of additional income on fixed income securities such as U.S. Treasuries, federal agencies, corporate obligations, CDs, but it's still not a tremendous move in the fixed income market. So that's sort of a highlight of the general market conditions. In regards to the return-seeking portfolio, we skip a few pages. On the first page, you can see all the various indices. Just a couple of quick highlights. Over the last year, essentially every single sector in the U.S., that first entire column saw strong performance. In terms of the laggard was the Russell 1000 Value Index, but that increased 15.5%. Very, very impressive returns. On the high end was the smaller cap stocks, and we saw them increase by 24%. Very, very good performance. So in terms of having a diversified portfolio in stocks, definitely helps increase the value of the return-seeking portfolio. It wasn't a different story for the rest of the world in terms of the next shaded area, the international equities. We also saw international equities increase by 20%. Areas that weren't very good were REITs, real estate investment trusts, and that's because of rising interest rates and the impact of interest rates. Basically, they had good performance before, and now other sectors, there's sort of a sector rotation into traditional domestic and international equities. And then one thing that helps all of us is that if you look at gas prices have gone down quite dramatically and have stabilized in the $2 range. We're not seeing $3, $4 gas prices like several years ago. So if you look at something like the commodity index, which is the third line under alternatives, you see commodities were down by 6.5%. Very, very poor performance. And this was one of the things that we've talked about over the last couple of years. There is no exposure of the portfolio to commodities because we felt that with high gas prices, many countries basically needing to export oil, that there wasn't any catalyst to see higher oil prices in the future. So we don't have any commodity exposure in the portfolio, and that's one of the reasons why performance has been very good. Fixed income returns were in the low 1% range for basically high quality investments. If you go into the high yield sector, you saw a lot higher returns, but these are high yield is also the same as junk bonds. So these are below investment grade securities, but because of the underlying fundamentals of the U.S. and internationally pretty strong, these bonds have done very well. So we have more information about the economy on the next several pages. Going into your specific portfolio, so the planned performance summary. So not before that tab, but just a little bit before, a couple pages before. So I think it's 4 pages before tab 3.
Is it 2.1?
Yeah. Yeah, 2.1.
It's
One more page. There's 2.
There it is, right there.
Yeah. Yeah, right there. So what you care about is your particular portfolio. So on the very top line is the returns over various periods of time. So for year to date, your portfolio generated a return of 7.61%. And the bogey that we were hoping to achieve, which is the benchmark, was 7.24%, outperforming. So in terms of the decisions that we're making, in terms of the investment managers we're selecting, and the asset allocation has done well. Over the last year, we think it's a pretty solid return of 10.54%, but we did trail the benchmark slightly. A couple things weren't going in our favor in terms of timing-wise, but over the last 2 years, we were ahead by about 20 basis points. So translate into dollars on the next page. What that means, over the course of the last year, the return-seeking portfolio increased by $1.6 million. Year to date, it was an increase of $1.2 million, and then for the quarter, it was $553,000. So in terms of all going well, we continue to closely monitor the developments of the U.S. as well as the international community, and basically all things are suggesting that the economy is going to continue to maybe not be robust in terms of the politicians. We hope to see 3 to 4% growth. This means that lots more jobs are created. It's sort of running on all cylinders, but we're having solid growth in the low 2% range. And it's very consistent. We're not seeing huge swings in terms of periods of great growth and then periods of weakness. Because of that solid growth trajectory, we think domestic equities and international equities are going to do very well. So we continue to be slightly overweight those sectors. You can see that on the next page in terms of the orange line is the target allocation based upon the benchmark, and we make small little bets in terms of asset allocation. So the blue bar is a little bit further to the right than the orange bar, which means that we have an overweight in domestic equities. And we also have an overweight in international equities. This is all to our belief that we think that equities, basically traditional stocks, are going to do well in the next 12 to 24 months. The next section is about the liability defeasing portfolio. And the largest concern there is making sure that we pay all your bills on a timely basis. And we work with Bill's office in order to disperse those funds. And we make sure that there's plenty of liquidity in the portfolio. As we mentioned before, $525,000 was expected to be drawn from the account during the quarter, which it was. And then this particular chart on the bottom shows how much in cash flows during the fiscal year we expect to be paid to the beneficiaries. So in terms of the portfolio is going to need to spin off about $1.3 million in order to pay all the projected expenses. And that is based upon the actuary reports that are ordered every year. And there should be one in the process, if not completed very shortly.
It's in process.
So we compare last year's actuary report to the current estimates and make some adjustments to the portfolio.
Okay.
The portfolio is very high quality in nature, and the various pages on the following pages shows the asset allocation in terms of longer term out to 10 years. We're investing in treasuries, stalwart. We don't have to worry about any risk, or hopefully not, with the U.S. Treasury and the federal government. And then on the shorter end, within 10 years, we're investing in corporate bonds. There's a pretty nice spread, and we have a very comprehensive review process to review all of the underlying credits to make sure that they continue to have fundamental strength. S&P and Moody's continues to change the rules of the game in terms of they basically have changed the scale. So in terms of before you would buy AA names, and there was an abundance of AA names. Now there's not. So you have to be a little bit more willing to buy single A names, but they basically represent the same quality of the issuers as before. For example, before the financial crisis, General Electric was AAA rated. And now General Electric actually has a single A rating by S&P. ExxonMobil had AAA ratings. Now ExxonMobil, which is I think is AA rated by one of the issuers. So in terms of everything has essentially been lowered a notch, and because of the new rating scale. So if you're comparing things from now to 15 years ago, yes, it would look a lot different. Our internal processes have had to change because of how they're rating securities. So in terms of, but we feel very confident of the issuers within the liability defeasing portfolio. So there's more details about the portfolio. Any questions that you might have?
I assume you're planning for a market adjustment.
Yeah,
this fall.
in terms of, there's been talk about market corrections in terms of, there are a couple factors in terms of one, you sort of expect a pullback, a 10% pullback. And a lot of people keep on saying about a 10% pullback, but if the stock market goes up 5% and pulls back 10%, you're only 5% lower than what you were. And then we've seen that if there has been any pullbacks, it's been very much reversed quickly. So in terms of we aren't that good in terms of trying to time all the peaks and valleys, but in terms of, those are very small moves. What we're looking for is basically significant sentimental changes or significant fundamental changes to the economy. If we thought the economy was heading towards a recession, we would definitely reduce the level of risk. But in terms of these small corrections, this is all sort of trading ranges per se. And then the other thing that we've experienced, and we haven't fully factored that in terms of what does this mean, is volatility. So in terms of when you invest in the stock market, one of the things that most investment advisors would say is that you're going to experience volatility. Some days you're going to see the Dow Jones Industrial Average go up by 300 points, and some days it's going to go down 300 points. If you sort of think back over the last 18 months or so, there's not any type of alarm, warning bells where it's like NBC is saying this, it's like the stock market doing down 600 points. Basically, it's been very much a very, very tight band in terms of, there was a period of over 200 days that there wasn't a change in market value by 1%. It was one of the longest streaks in about 30 years. So in terms of what that does is that it makes people more comfortable that nothing bad's going to happen. So are people throwing more money into the market that may not be as comfortable with the long-term risks and volatility, and that might be a little bit more speculative money. So that could basically drive maybe a correction, but in a 10% correction. But that's any type of short-lived volatility kind of reverses itself. Right now, the volatility that we're experiencing is with North Korea. So in terms of
That's what I'm hearing. That's
yeah, so in terms of the last couple of weeks with some of the sabering between the two governments, we saw some stock market volatility, but in terms of, we're not seeing a 1,000-point decline. We're seeing very, like maybe a couple, like a percent, but it reverses itself the next day. So.
Have we ever seen the bond ratings that you were talking about, with the fluctuation? Have we seen that in past years? I mean...
Not really, in terms of, I think the rating agencies were extremely criticized for having high issues such as Lehman Brothers that had essentially a single A rate and then go into default within days. They also had high quality ratings on a lot of different commercial paper issuers, and we experienced some government entities buy it at the beginning of September, and 3 weeks later it defaulted and carried a A1 plus rating, which is the highest short-term credit rating. So I think there was a black mark by the rating agencies, is that you can't slap a AAA rating on everything. So in terms of, it has to be a little bit more measured. And if the federal government, S&P actually downgraded the United States Treasury to AA+. And when you have the ceiling as being the U.S. Treasury, because you would think that that represents a risk-free asset, that how can you have anything else with a higher credit rating? So they basically lower the ceiling, which then basically lowers all the underlying corporate credit rating securities. So we're actually seeing more talk that Fitch might actually downgrade the U.S. Treasury from AAA because of the concerns about the budget and the debt ceiling. So in terms of, as we mentioned earlier, it's like you have a Republican Congress as well as a Republican White House. Why haven't they taken action in order to increase the debt limit? So right now, the U.S. Treasury, that particular agency is using what's referred to as extraordinary measures in order to make sure it continues to pay all of its bills. But all those extraordinary measures are exhausted by the end of September, early October. So we're heading into the last 45 days. So in terms of if no one really expects the Treasury to default, but that definitely could increase volatility in the market because it shouldn't happen. So.
Are there any other questions? No? comments? This is such a quiet group. All right, well, thank you for this presentation. As always, we appreciate the work that you all do managing this pension system. It's nice to sit in a positive pension system atmosphere compared to this. In your packets today, you also have a copy of the ordinance that was approved that changed and revised the election procedure. So now you guys have a copy of that for your records. Was there any question about that?
I had a quick question.
Sure.
When it talks about the, that's 1, 2, 3, 4, 5, about 6 lines down. Such any vacancy shall be filled from an authorized group or class of persons identified in KRS 67A.320. What is that class? Because I looked it up and.
Well, 320 only authorizes the retired members to fill it, so there's no alternate class. So if we get to a point where we have a vacancy for the
It
retired
just stays
membership,
open.
and unless we get the statute amended to identify another group that we can fill it from, because the statute governs that, we don't have the ability by ordinance to identify another class. of
Right, no,
people.
well, that's how I read it. I was like, well,
So-
there is no other option. Okay.
So, yes.
Okay.
So I think where we're at right now is, we've got our 4th council member on board, so we just need to initiate, since everybody's in a holdover position, we need to go ahead and initiate the special election procedure now to have them self-nominate and then go through the regular to fill out for the unexpired term of the 2 years. So that's what we need to do since none qualified last time. So
Okay.
I think we probably just need a motion to go ahead and have the special election procedure initiated and then get either the self-nomination or the one signature and start the process to fill out the terms.
Okay, all right.
So moved.
All right.
Second.
Okay, all right. The motion by Councilmember Bledsoe, second by Councilmember Evans to move forward with the election for our retirees. Did you all understand that? Did you hear what, Okay, because, now you all can move forward with the process. Is there any questions or any discussion on the motion? No? All right. All in favor of the motion, please say aye.
Aye.
Any opposed? All right, thank you, and thank you for that information too. So I'm sure you all will work with Deputy Council Clerk Stephen about the process, and you'll have any questions or anything, I'm sure that the Council Clerk's office will be most happy to help you guys. So, all right.
And I think for the 320 issue, if the board wants to try to get a proposal, I guess, to the city's lobbyists to amend 320 to address that particular issue now, and I think this is a full session, isn't it, this year?
It should be
So
in January, yes.
We should probably try to do that by the next quarterly meeting and then make that recommendation or do a resolution with a suggested amendment. If we can
Okay.
come to agreement on who should be identified or how that should occur once we get to a point where the retirees we don't have 3 to fill our vacancies.
All right, so would I be able to entertain a motion that we have a draft resolution maybe presented at the next quarterly meeting regarding KRS, the section 320, so that we can start discussion on that matter?
Sure.
Are there any proposals? I mean, does somebody have a proposal of what the draft is going to be, or who's going to decide what the draft is going to be?
Well, I think that I would look to our law department to look to see if there are other best practices out there. And clearly, we have the authority here in this board to make decisions. And if we like it, if we do, that's great. If we don't, then I think that it's at the purview of this group here. So, I mean, it doesn't prohibit us from doing our own research either. So, if you wanted to. So, is there a...
Do we need a motion for that?
Yeah, I think...
So moved.
All right. Motion by Councilmember Bledsoe. Is there a second? Second. All right. Councilmember... no. Ms. Danaher. No. I've got the names all messed up today. Summers. Ms. Summers. Seconded by Ms. Summers to ask the law department to prepare a draft resolution for the next quarterly meeting with some language that we could consider and start the discussion. Is there any discussion on the motion?
They bring options, like different classes of groups,
And
because
then we could actually, yes, and then once we get an approval, what I'll do is I'll just do like the underline and strike through like you would for any proposed legislation to LRC, and then we can, by resolution, pass that, and we can take it to the city's lobbyists and see if they support that to go forward.
All right, any further discussion on the motion? Then all in favor, please say aye.
Aye.
Any opposed? All right, thank you all then. As this was the last item on the docket, or the agenda, the next meeting is set for January 31st of 2017, and that'll be proper timing for right before the legislative session, or right in the middle of it, so, or beginning. So, yes.
Our next meeting's October 31st. I think you said
Oh,
January.
well, obviously I looked at the wrong date. Sorry.
I thought January was kind of
Yes.
far away.
Yeah.
Thank you,
No
thank you.
problem.
Yeah, that's going backwards, isn't it? October 31st is our next meeting, so, that being said, is there a motion to adjourn?
So moved.
Second?
All right, a motion second. All in favor, say aye.
Aye.
Any opposed? All right. Thank you all for your time today.